Financial independence is one of those phrases that is thrown around everywhere. From YouTube ads promising overnight success to influencers telling you that quitting your job is just one side hustle away. But the truth is far less glamorous and far more powerful. Real financial independence isn't about hype, luck, or some secret investing hack. It's about structure, patience, and the math behind how money compounds over time. In this video, we are going to break down the reality of achieving financial independence, not the social media fantasy, but the actual numbers, strategies, and mindset that make it possible for ordinary people to become financially free. Let's start with what financial independence actually means. The most accurate definition is this: you are financially independent when your investments or passive income generate enough money to cover your living expenses indefinitely. That means you could stop working today, and your wealth would continue to sustain your lifestyle without shrinking. The common benchmark used by experts is the 4% rule, which comes from the Trinity study, a piece of research showing that if you withdraw 4% of your portfolio each year, your money can last 30 years or more depending on market conditions. So, if you want to live on $40,000 a year, you need a portfolio of about $1 million. That's the math, but getting there is where most people misunderstand the process. One of the biggest myths about financial independence is that you need a massive income to start. That's completely false. What you need isn't a high income, it has a high savings rate and consistent investing discipline. Two people earning the same salary can end up in completely different financial realities simply because one saves and invests 40% of their income while the other spends everything. The percentage of your income that you save and invest determines how fast you can reach independence, not how much you earn in absolute terms. Let's put this into perspective. If you save and invest 10% of your income every year, it could take you around 51 years to reach financial independence. But if you raise that to 30%, it drops to around 28 years. At 50%, it's closer to 17 years. That is the math of compounding and the power of the savings rate. The more you put to work, the faster you buy your freedom. Another myth is that financial independence requires you to sacrifice everything fun in life, to live like a monk and eat rice and beans for decades. That's a false dichotomy. Financial independence isn't about deprivation, it's about optimization. It's about cutting what doesn't matter and amplifying what does. The people who achieve it aren't necessarily the ones earning millions, they're the ones who design their lifestyle intentionally. They live below their means not because they're cheap, but because they value freedom more than temporary luxury. Now, let's talk about income sources. Financial independence doesn't rely on just one engine. The average financially independent person builds a portfolio of income streams. The most common ones include dividend-paying stocks, rental income, index fund portfolios, and sometimes business ownership. The goal is diversification, so that no single source of income can break your system. The mistake many make is chasing passive income that isn't truly passive, like dropshipping or day trading without skill. Real passive income takes upfront effort, investment, and time to stabilize. Then there's the investing strategy. If you want to achieve independence safely, you need to understand asset allocation. This means spreading your investments across equities, bonds, and cash equivalents to balance risk and return. Historically, a globally diversified stock portfolio has returned around 7 to 8% annually, adjusted for inflation. Bonds reduce volatility but also reduce growth potential. The right balance depends on your risk tolerance and how close you are to your goal. Younger investors can afford higher stock exposure because time smooths out volatility. As you approach independence, shifting to more conservative allocations helps protect your capital. Let's address another major myth, that financial independence means never working again. The reality is, many financially independent people still work, but they work by choice, not by necessity. The goal isn't to sit on a beach for the rest of your life, it's to reclaim your time and choose what you do with it. Independence gives you control, not idleness. It is the difference between needing to work for money and using your money to work for you. Now, let's look at the steps you can take to get there. The first is financial awareness, knowing wherever your dollar or pound of your income goes. You can't improve what you don't measure. Use tools or spreadsheets to track your expenses. The second step is to increase your income while keeping your lifestyle constant. The gap between your income and expenses is the engine that fuels your investments. When your income rises, don't let lifestyle inflation consume it, redirect it into investments instead. The third step is automating your investing. Whether it's monthly contributions to an index fund, retirement account, or ETF, consistency beats timing. Most people fail because they try to outsmart the market or wait for the perfect moment. The reality is, the best investors build wealth through dollar-cost averaging, investing regularly, regardless of market conditions, so their average purchase price smooths out volatility over time. Now, let's talk about what kills financial independence: debt and poor money habits. Not all debt is bad. Strategic debt can be used to acquire appreciating assets, like property or business equity. But consumer debt, credit cards, car loans, or lifestyle borrowing is the enemy of freedom. It shifts future income into the past and traps you in the cycle of repayment. Paying off high-interest debt is the first guaranteed return you'll ever get, because if your credit card charges 20%, eliminating that balance is equivalent to earning 20% risk-free. Another overlooked factor is tax optimization. Taxes can either erode or accelerate your path to independence, depending on how you manage them. Using tax-advantaged accounts, like retirement plans or ISA letters, can compound your returns more efficiently. Learning about capital gains, dividend tax treatment, and legal deductions isn't just for accountants, it's for anyone serious about wealth. Then comes inflation, the silent killer of purchasing power. If your money sits idle in cash, inflation is quietly eating away its value every year. That's why investing isn't optional, it's necessary. Financial independence is a race between your asset growth and the declining value of your money. The faster you learn to invest, the sooner you win that race. So, what's the actual formula for financial independence? It's simpler than people think. Annual expenses times 25 equals financial independence number. That's based on the 4% withdrawal rule. Once your portfolio reaches that size, you can theoretically withdraw 4% annually and sustain your lifestyle indefinitely. Of course, you'll need to adjust for inflation and market cycles. But it's a solid framework to aim for. Here's a practical example. But perhaps the biggest reality of financial independence is that it's not a destination, it's a continuum. You don't wake up one day and suddenly become financially free. You move gradually from dependence to partial independence, and finally to complete independence. At first, maybe your investments cover 10% of your expenses, then 50%, then 100%. Each stage gives you more freedom and peace of mind. The process itself changes how you think about money. Finally, let's be honest about what financial independence requires: time, patience, and consistency. There are no shortcuts. Even with the best strategy, it typically takes 15 to 25 years of disciplined saving and investing to reach full independence. But the earlier you start, the more powerful compounding becomes. Remember, money grows exponentially. The last 10 years often account for half your total returns. So, if you take one message from this video, it's this: financial independence isn't a fantasy. It's math plus mindset. The myths about needing huge income, living frugally forever, or quitting your job instantly are distractions. What matters is consistency, optimization, and understanding how your financial system works. Build assets that pay you, protect your capital, automate your growth, and keep learning. Because the real goal isn't just money, it's freedom, time, and the ability to choose how you live. And remember, none of this is financial advice. It's education. Always do your own research, consult a licensed professional where necessary, and understand your risk tolerance before investing. If you found value in this video, don't forget to like, subscribe, and share it with someone who's chasing financial freedom for the wrong reasons, because the real path isn't about hype. It's about building the system that buys back your life.